Thanks for having me. It's a great time to be talking about debt. And no, I did not grow a beard, and no, I am not Dean Dolcinos, which you'll see in the flyer. But interestingly, I guess my parents initially named me James, so I was going to be the second one. Then I became a John last minute, so that was some interesting tidbits. In any case, the goal here is just to sort of give you guys a quick 15-minute introduction to sort of the debt capital markets in the United States. I'm JB Gerber is what I typically go by, or John, and I'm really focused on debt origination. Did it for 11 years in the United States, and have also now moved to London to sort of look at similar opportunities across Europe. But wanted to give sort of a very brief introduction to Barings. You guys can start booing if it goes too long, but in general, Barings is sort of a global asset manager with $270 million of assets under management. Within the real estate group specifically, there's sort of a $50 billion asset management firm. A large majority of that is in the debt space in the U.S., and so that's really why I'm up here talking. And we'll go through sort of the various loan types, whether it's core, core plus, or mezzanine debt lending. But Barings in the United States is very active across all of those segments, and that's really sort of why I'm here. The goal is really to walk through sort of historically where we've been in the debt capital markets, and then we'll focus on some of the various loan types that you can sort of invest in the United States. And then lastly, we'll touch on where we feel like the debt capital markets are headed. You sort of heard that sort of pension funds in the U.S. have become very active in this alternative space. We'll sort of see where we think it's headed from there. There's a lot going on in this slide, so bear with me. But basically, what we're looking at is the various lending types in the United States. So you have your primary lenders, which are your CMBS lenders, commercial banks, life insurance companies, and then the GSEs, which are the government-sponsored entities, which are primarily focused on the multifamily debt space. As you can see, with the previous cycle, there were a lot of activity going on, primarily in the CMBS space, but also in the commercial banking space. And through this following recovery that we've seen since the GFC, there's sort of been some clear, what I'd call winners and losers. As you can sort of see on the bottom, in here, this is the CMBS conduit market, which was up here pre-cycle. So you're sort of seeing haven't really gotten back to recovery. We'll sort of touch on why that is. Whereas up here, you're seeing sort of commercial banks in a strong recovery, but you're also seeing life insurance companies and GSEs making up a large portion of the recovery and really benefiting from the GFC in general. And again, life companies have roughly doubled their originations as well as some of the GSEs, but because the GSEs are really focused on the multifamily space, you haven't seen the same interest in sort of office, retail, logistics, or hotels. And so now we'll just sort of touch on sort of the evolution of what loan types have been through as we cover, core, core plus, and mezzanine loan structures. As you can see, sort of the pre-GFC cycle where you had 80% loans were very common. Today they're at 65%. This is largely driven by all of the same sort of lender types that we've talked about. They're still active in the space. Those CMBS is obviously at a much lower sort of percentage. And that's really driven sort of credit underwriting maintaining its strength, whereas pre-cycle there was a lot of origination going on that was sort of underwriting to win a deal versus underwriting the sort of fundamentals of the specific asset or loan. You can sort of touch on spread differential. Spreads are still, roughly 2 times what they were pre-cycle. And again, you've got, extremely strong credit underwriting, and as we move into sort of core plus loan evolution, it's a lot of the exact same characteristics. You're looking at sort of roughly 2 times what you would in terms of spread. Credit underwriting has maintained its strength, but the biggest difference is really where you're looking at the primary participants. CMBS, commercial banks, life insurance companies, and specialty finance companies were very active in the core plus space pre-cycle, whereas today it's a much more focused on alternative lenders and debt funds, as was previously discussed. This is where we're seeing a lot of growth in the space to sort of fill in the gap where banks and or life companies are uncomfortable with sort of any type of transition or non-durable cash flows. And that's sort of, I guess, how I would classify, core plus or value add debt investments. If there's any type of hiccup to the cash flows, long-term leases, lease rollover, renovation, or pure lease up, this obviously, falls into the core plus loan space. And beyond that, you've also got sort of a construction loan component where you may have partial pre-leasing, where you may need subordinate debt, which goes to touch on sort of our mezzanine loan evolution. These, similarly to the core plus space, the participants have really changed over the previous cycle. Alternative lenders and debt funds are primarily the mezz players today, whereas they were sort of more Wall Street or specialty finance companies previously, pre-GFC. And then the other large takeaway is, whereas there were a lot of CMBS senior loans on most of these mezzanine debt products, today the primary senior lender is actually a commercial bank that for whatever reason is uncomfortable sort of going up the capital stack, usually because of sort of an exit risk or a pre-leasing concern that holds them back. So I'd also just sort of point to the simplicity of the capital stack today versus what it was pre-GFC. As you look at sort of this tranched mezz structure pre-GFC, a lot of those lenders, on top of sort of being in a tranched mezz position, were also getting additional leverage sort of behind the scenes, whether through sort of repo lines or a CDO type structure. So there was just a lot of built-in leverage, even within leverage. Whereas today, a lot of the debt funds are holding this mezz position sort of within a balance sheet. And again, credit underwriting is very strong because you have a senior bank sort of in that position that is also looking at the last dollar on the mezz. So I think the general takeaway from the mezz perspective is, again, you have sort of a more secure position, and underwriting standards have remained relatively strong. And all this sort of gets to the point of why. What's driving these changes? Why have the debt capital markets behaved in this way? And it really goes to government regulation. That's really the short answer. There's probably some psychological reasons as well, as some of the previous lenders, had gotten burned with the weakening credit underwriting. But ultimately, it's sort of, Basel III has really impacted banks' ability to originate, value add or core plus loans where there's any sort of disruption in cash flows, as well as construction lending. And you can sort of see at this chart on the bottom right. I think there was another chart similarly posed earlier. This is probably not where we expect to be, but it really has not come back to sort of its historical norm. And in a sense, it's, the Basel III regulations were really brought in to de-risk the system, and in a sense they have. I think, as we've talked about or heard from folks across various asset classes, on the equity side, you're seeing that supply and demand are in very strong balance. There's obviously bubbles here and there when you look at specific submarkets, but overall, supply and demand feels very good and isn't run away. And again, we don't expect that to occur with most of these commercial banks pulling back. And additionally, it's the Dodd-Frank regulation that most folks have probably heard about, that's really impacting CMBS originators' ability to stay profitable and originate at gross volumes, anywhere near where they were previously. Which gets us to what's next. You hate to be a bore. This is sort of the original chart that we had showed previously, but the general takeaway that I feel is it's more of the same. These regulations are still being impacted. Banks really didn't even start looking at them for probably a year or two ago. And so, today you're really seeing them take that to heart, and then you've got, it's going to take a while for them to really grasp what those regulations mean. We've heard about gateway cities. We've all heard about them. I think there's going to be a ton of liquidity in those cities for the gateway markets, or for multifamily that's stabilized, as the GSEs really sort of dominate that space. But overall, if you're in a non-gateway market in an office, retail, logistics type setting where you may have some disruption in cash flow, there's going to be a ton of opportunity, we believe, for sort of non-core loans. And then I would just say, you always heard about the maturity wave coming through that everyone sort of thought would come through and wreak havoc. We're sort of just seeing that now in 2017. So I think there's going to be sort of continued pressure from a supply and demand perspective of debt. That will be very interesting to see how this was originated with the weak credit underwriting, and then we're going to follow that up with a strict credit underwriting perspective. And then lastly, as I'm getting close here, as interest rates start to rise, as the Fed is sort of forecasted, we think there's also going to be a growing demand from a borrower perspective to lock in rates and go long term, which is going to sort of potentially disadvantage the banks a little bit, as they're primarily floating rate sort of short-term lenders. So are we ready to go? Okay.
Well done.
Thank you. And if you have any